Okay, so in this exercise, we're going to go ahead together and build a simple model to calculate the expected return of a shipping project. Now, we're going to assume that we buy an LNG vessel, which stands for liquefied natural gas vessel, at a certain price. We will finance the acquisition of this vessel through a mix of debt and equity. We will assume that we have the ability to charter this vessel to an oil and gas major for a period of 5 years at at a certain daily charter rate. And finally, we will exit this investment by selling the vessel in the end of the 5th year and paying down any outstanding debt balance. Now, I have attached both the completed and blank versions of this model. We will work together in the blank version, and you can go over the completed version during your free time in order to check your work. So, let's start by going over the model and the various sections. So this is a very basic and simple model. It is just 50 rows, and it has the following sections. The first section is the assumption section. We have general assumptions, assumptions about our charter contract, revenue assumptions, and finally we have our financing assumptions. We're going to build a cash flow waterfall. Have in mind that this is a project finance case study, so the only thing that really matters here is cash flow generation. We're not going to focus at all on the income statement or the balance sheet. We are going to build our debt roll forward schedule and come up with our principal repayments and interest payments. We will build our vessel depreciation schedule, which we'll use in order to come up with a vessel value in the end of the 5th year when we sell this vessel in order to exit our investment. And finally, we will calculate our return for this project. Okay, so let's start going over the various assumptions before we start building the model. So, general assumptions, we're going to assume that we buy this vessel for 200 million. We're going to assume a utilization rate of 99%. As mentioned, the vessel is going to be chartered under a long-term time charter contract or lease contract for a period of 5 years. However, we're going to assume that we're going to be earning our revenue not for 100% of the days included in this period, but for 99% in order to account for any unforeseen of higher days. This is just for being conservative. I've seen rates that are lower depending on the shipping industry. It could be 98, 95, 90%. So we're going to go ahead with 99% for now, and we can later on play with this assumption. Operating expenses or OPEX per day is going to be 15,000 per day. And we're going to assume that this number grows on a yearly basis by 2%, which is approximately equal to the inflation in the US. And finally, we're going to assume that this is a brand new vessel that has just been delivered, has hit the water, and for this reason, it has a useful life of approximately 35 years. Usually, useful life exceeds 35 years, could be 40, could be more than 40, but for now, in order to be conservative for this exercise, we're going to assume that the useful life of the vessel is going to be 35 years. Now, revenue assumptions, as we said, is going to be fixed to an oil and gas major for 5 years. We're going to assume that the daily charter rate is going to be 75,000 per day for the entire duration of the charter contract. And finally, our financing assumptions, we're going to assume a loan-to-value ratio of 70%. This means that the loan that we're going to raise to finance the acquisition of this vessel is going to be 70% of the purchase price, which is 140 million. The term of this loan is going to be 5 years, which means that we need to pay down the loan in the end of the 5th year. And the profile of this loan is going to be 12 years. This means pretty much that the profile is actually used in order to determine what the annual debt repayment is going to be. And you do this by dividing the loan amount by the profile to get the annual debt repayment. 140 over 12 years is an 11.7 million debt repayment on an annual basis. And since the loan has a term of 5 years, we are going to pay down the loan from 140 to this. The total repayment is going to be 11 times 5. So the total repayment is going to be 50.3. So the loan in the end of the 5th year is going to be paid down to 140 minus 58.3. So approximately 82 million. So I'm just going to erase this. We're going to see this again when we build our debt roll forward. And finally, we're going to assume that the spread for this facility is going to be 2.75% above LIBOR. And as a proxy for LIBOR, we're going to use the 5-year US swap rate, which is approximately 1.6%. Again, these are assumptions. They depend very much on the market. And for now, these are the assumptions we're going to make. We can always play with these assumptions later on and see how the numbers change. So now that we've gone over the assumption section, let's start by building our cash flow waterfall. So calendar days refer to the actual number of days within a year. So this is 365, not taking into account leap years. This is very straightforward, 365 every year. Now, dry dock of hire days. Dry docking in shipping means maintenance pretty much, or service. Think about a car, you have to service it every now and then. The same goes for vessels. You need to perform a dry dock. And the dry docking schedule for a vessel varies depending on the age of the vessel, depending on the type of the size of the vessel. In this specific instance, and for simplicity purposes, we're going to assume that we're going to have one dry dock or one special survey, which is going to take place in the end of the 5th year or within the 5th year. And during this period, the vessel is going to be off hire. Hence, we need to assume a certain number for the days that the vessel is going to be off hire. So let's say that it's going to be 20 days. 20 days the vessel is going to be out of the water, being maintained, so it's not going to be earning any revenue. Now, operating days are going to be the calendar days minus any dry dock of hire days times the utilization rate that we assume, which is 99%. Lock this cell, copy the formula to the right. The charter rate, we're going to use a VLOOKUP formula here to pull the values from above. So we're going to search for this value. This is the table that we're going to use. Lock this table. It's the 4th column, and we're going to use 0 for this input in order to assume a perfect match. So it pulls from over there, from the assumption section, from the revenue assumptions, the charter rate that is going to apply for each period, and it's, as we mentioned previously, $70,000 per day for the entire duration of the charter contract. Finally, we'll calculate an inflation index in order to adjust our operating expenses on a yearly basis, since, as we mentioned, are going to grow by 2% per year. So we're going to build this as follows. We're going to start by 1, and we're going to grow this number by 1 plus the inflation rate per year. This is going to give us our inflation index. Okay. So let's go ahead and calculate the various figures in the cash flow waterfall now. So we're going to start with revenue. Revenue is going to be the operating days that we calculated above times the charter rate. And we're going to divide this by 1 million in order to have simpler numbers. So 27.1 is going to be the revenue. As you can see, in the end of the 5th year, we're going to have less revenue, and this is because of the off-hire days for dry dock. If we delete this number, of course, the revenue matches the revenue of the other years. So let's input for now 20 in order to reflect the assumption that we're making. Now, operating expenses. So in shipping, if a vessel is off hire, as it's going to be, for example, over here, 342 days instead of 365, the vessel earns revenue only for the days that is on hire, hence 342. However, operating expenses are being paid for the entire calendar year, for the entire calendar days, because the vessel, for example, is going to have the crew on board still, right? The crew might not be on board if the vessel is off hire, but might be on the side, standing by. So you really need to pay or incur the operating expenses on a daily basis, even if the vessel is not on hire. Hence, we're going to use the calendar days times the OPEX per day, which we're going to log, and we're going to multiply this by our inflation index to take into account our inflation rate. And we're going to divide this by 1 million again and copy the formula to the right. So this is our operating expenses line item. Dry dock, we're just going to hard code this number. The off-hire days are going to be 20, as mentioned previously, and the cost for this dry dock is going to be it's going to be 1.5 million. And we will assume that this is paid in the end of the 5th year. In reality, this payment might be broken down in more installments and might be paid, some portion might be paid before the dry docking takes place and some portion after the completion of the dry docking. But for simplicity purposes, we're going to assume that the 1.5 million is being paid entirely in year 5, in the 5th year. So let's come up with our EBITDA, which is going to be the sum of the above line items. And let's also calculate the free cash flow. We don't have any principal repayment and interest expense payments right now, so let's just make sure that the formulas are correct, and let's move to the following sections in order to build the debt schedule. So the debt schedule, I'm going to split the screen now, Alt WS, and link the ending loan balance at drawdown to the assumption that we've made in the financing assumption section, which is 140. So we're going to draw 140 million, and the remaining 60 million is going to be an equity contribution. And we're going to build our debt roll forward. This is going to be, so the sum of the ending balance in a year is going to be the sum of the beginning balance minus the repayment for that year. The repayment is going to be very simply the loan amount that we have assumed divided by the, as we mentioned previously, profile of the loan. So let's look in this cell. So it's going to be 11.7 million per year, and as mentioned previously, this is going to reduce our loan balance to 82 plus something million in the end of the 5th year. The reason it doesn't go to 0 is because we have a term of 5 years and a profile of 12. If we had a term of 12 years and a profile of 12 years, for example, then this would assume a straight line amortization of the loan, and it would go down to 0 in the end of the 12th year. But for now, since the term is 5 years, we just have a balloon payment, which is going to be 82 million. Now let's calculate the interest rate and interest expense for these loans. So the interest rate is going to be the sum of the spread and the 5-year swap rate, which we're going to use as a proxy for the LIBOR, as we've discussed. Let's lock these cells and go copy the formula to the right. Then we're going to go ahead and calculate our interest expense, which is going to be the interest rate times the average loan balance during the year. And it's important to do that in order to be a bit more precise with the calculation of the interest expense, because debt is actually being repaid during the year. Hence, we're going to be more accurate if we get the average balance than just the starting balance. So this is going to be our interest payment for every year. Now, let's move to the vessel depreciation schedule. So the vessel purchase price is 200 million, as we've discussed. So let's lock this cell. The depreciation is going to be, we're going to assume a straight line depreciation. We're not going to assume a residual value right now. So it's going to be the purchase price divided by the useful life of the vessel, which we've assumed to be 35 years. So this is the depreciation per year. It's going to be the same for every year. And then we're going to take the sum of these two cells in order to calculate the accumulated depreciation for this vessel. And then we're going to take our purchase price and deduct our accumulated depreciation in order to calculate an estimated vessel value in the end of every year. So, as you can see here, this is a market neutral approach, meaning that we don't assume that we know where the market is going to be in 5 years from now, or even better, we assume that the market is not going to change, price is not going to increase or decrease, and we just use the depreciation in order to come up with the vessel value in the end of the 5th year. And finally, we're going to go ahead and calculate our return over here, since we have everything that we need. Actually, let's go back to our cash flow waterfall and link the principal repayment, which we get it from the debt schedule, and the interest payment is going to be negative, which we get it again from the debt schedule. So as we can see, this is the free cash flow for every year during the term of this project. So now that we have this number and we've completed our cash flow waterfall, we can go ahead and calculate our return, the return for this project. So I'm going to split the screen again. The return is going to be calculated as follows. So the equity outflow for this project is 60 million. And the way we get to that number is the purchase price of this vessel, which is 200, minus the debt that we raise, which is 140. This is 60, which is the amount that we need to come up in order to purchase this vessel after we raise the debt. And there's going to be just one equity outflow in year 0. Now, free cash flow to equity, or the equity that is being, the cash flow that is being generated, is going to be the number that we have in our cash flow waterfall. So 4 million for the first year, and then we copy the formula to the right to calculate the same metric for the remaining years. Debt repayment, or even better, let's call it debt prepayment. Debt is going to be the balloon for this loan. As you remember, the term is 5 years and the profile is 12. Hence, we're going to come up with an outstanding debt balance of 82 million, and we need to assume that we pay down this balance from the proceeds of the sale of the vessel, which are going to appear over here. So the proceeds from the sale of this vessel are going to be the vessel value minus any commissions. So we're going to pay to the vessel brokers, to the sale and purchase brokers. But for now, for simplicity purposes, let's assume that there are no commissions. So there's going to be cash inflow, which part of it is going to be used to pay down the outstanding debt balance. And then to calculate the total cash flows, we take the sum of these 4 line items. And we see that year 0, we're going to pay from our pocket equity infusion of 60 million. We're going to earn these cash flow during the 1st, 2nd, 3rd, and 4th year. In the 5th year, we're going to earn some free cash flow generated from the operations of the vessel. And we're going to sell the vessel for 171.4 million and use part of the proceeds to pay down the outstanding debt balance. And finally, we just need to calculate the IRR. Here, we're going to use the built-in Excel formula, which is IRR. And this gives us an IRR of 14.5%. And now let's just check whether we did this correctly. We switched to the completed version, 14.5%, 14.5%, so we're correct.